All right, everyone, buckle up. The financial world is on fire, and we've got the inside scoop right here on Bitcoin Bulletin. The pace of change is absolutely relentless, and if you're not plugged in, you're missing out on the biggest moves. Today, we're diving deep into a seismic shift in investment strategy. Next, we're uncovering a shocking corruption scandal that's shaking the foundations of justice. This story is a stark reminder of the real-world consequences in the digital asset space. Then, we'll dissect how economic giants and policy decisions are influencing digital asset markets, exploring the intricate dance between traditional finance and the new digital frontier. And finally, we're bringing you a crucial case study that's a wake-up call for every investor. Stay locked in because you do not want to miss these critical updates. Make sure you hit that subscribe button and ring the notification bell so you never miss a beat. Strategic investment shifts unveiled. Major players in the financial arena are increasingly exploring innovative avenues to gain exposure to the burgeoning digital asset market, with a particular focus on Bitcoin. A significant development is the growing consideration of preferred stock offerings as a strategic tool for investors seeking to navigate this complex landscape. This approach allows for a more nuanced and potentially less volatile entry point compared to direct ownership, offering a way to participate in the upside potential of cryptocurrencies without the immediate price fluctuations often associated with direct holdings. Preferred stocks, by their nature, often come with fixed dividends and a higher claim on assets than common stocks, providing a layer of security and predictability that can be highly attractive in the often turbulent digital asset space. This trend signals a maturation of the market, where sophisticated investors are developing more intricate strategies to integrate digital assets into traditional portfolios. It's not just about buying Bitcoin directly anymore. It's about building diversified investment vehicles that can harness the growth of digital currencies while mitigating some of the inherent risks. The appeal lies in the potential to gain exposure to Bitcoin's price movements through a regulated financial instrument, potentially accessible through existing brokerage accounts. This could democratize access for a broader range of investors who might be hesitant to engage with cryptocurrency exchanges directly due to security concerns, regulatory uncertainty, or a lack of technical know-how. Furthermore, the structure of preferred stock offerings can be tailored to meet specific investment objectives. Companies might issue these securities to raise capital for projects related to digital asset infrastructure, technology development, or even to hold digital assets on their balance sheets. The terms of these preferred stocks could include features that link their performance directly to the price of Bitcoin, or they could represent a stake in a company whose primary business is related to digital assets. This flexibility allows companies to attract a wider pool of capital and investors to gain exposure through familiar financial products. The underlying strategy is to bridge the gap between traditional finance and the decentralized world of cryptocurrencies, creating a more integrated and accessible ecosystem for investment. The implications of this strategy are far-reaching. It suggests a potential for increased institutional adoption and a greater mainstreaming of digital assets as a legitimate asset class. As more traditional financial instruments are developed to offer exposure to Bitcoin, the market is likely to see greater liquidity, price stability, and regulatory clarity. This evolution could pave the way for wider acceptance and integration of digital currencies into the global financial system, making it easier for everyday investors to participate in this innovative sector. The move towards preferred stock offerings is a clear indicator that the financial industry is actively seeking ways to incorporate digital assets into established investment frameworks, aiming to balance innovation with the demand for security and traditional investment structures. But what happens when the digital world collides with the harsh realities of crime and corruption? We're about to find out. Stay tuned as we uncover a shocking corruption scandal that's shaking the foundations of justice. Justice served in Gujarat Bitcoin scandal. A landmark verdict has been delivered in India, with 14 individuals, including a former member of the Legislative Assembly, MLA, and senior police officials, receiving life sentences for their roles in a brazen 2018 Bitcoin kidnapping and extortion case. This high-profile trial, conducted in Gujarat, has not only brought closure to a disturbing crime, but has also exposed deep-seated corruption within law enforcement and political circles, serving as a stark warning to the burgeoning cryptocurrency ecosystem. The case, which involved the abduction and coercion of a businessman, Shailesh Bhatt, centered around the illicit acquisition and transfer of digital assets, highlighting the intersection of cybercrime, violent crime, and systemic malfeasance. The intricate web of crime began when Bhatt, who had reportedly recovered 752 bitcoins from a failed investment in BitConnect, became the target of a criminal enterprise. Led by Nalin Katadia, a former BJP MLA, and involving a significant number of police officers, the perpetrators orchestrated a sophisticated kidnapping. Bhatt was held captive, subjected to brutal physical abuse and psychological torment, and ultimately forced to transfer 34 bitcoins and agree to a substantial ransom payment of $3.6 million. This shocking display of violence and coercion underscores the lengths to which criminals, aided by corrupt officials, would go to seize digital wealth, demonstrating a chilling blend of traditional extortion tactics and cryptocurrency exploitation. The judicial proceedings, overseen by Special Judge B.B. Jadhav, were extensive, involving the examination of 173 witnesses. The court found the 14 defendants guilty of grave offenses, including criminal conspiracy, kidnapping for ransom, illegal detention, and assault. Crucially, the prosecution successfully demonstrated the pervasive nature of corruption, leading the court to issue notices under anti-corruption laws for the implicated public officials. The imposition of life sentences under Section 364A of the Indian Penal Code signifies the judiciary's firm stance against such egregious acts and its commitment to dismantling corrupt networks that prey on citizens. The case also resulted in the confiscation of assets, including gold seized from the residence of a former police superintendent, Jagdish Patel, further emphasizing the pursuit of justice and accountability. This case is particularly significant as it sheds light on the growing threat of cryptocurrency-related crimes in India and globally. It highlights the challenges faced by law enforcement in tackling sophisticated digital asset fraud and extortion, especially when public officials are complicit. The verdict is expected to serve as a potent deterrent, signaling that severe penalties await those who exploit their positions for criminal gain. It also underscores the critical need for robust governance and stringent due diligence for all participants in the cryptocurrency market, from investors to regulators. The court's action reflects a global trend towards greater accountability in the digital asset space, emphasizing that even in the realm of decentralized finance, the rule of law and severe consequences for criminal activity will prevail. The systemic corruption exposed in this case necessitates a closer examination of internal controls and ethical standards within public institutions. Now, let's shift gears and look at how global economic forces are shaping the digital asset landscape. Get ready as we explore the impact of Fed data and tariffs on crypto flows. Market movers, Fed data and tariffs impact crypto ETFs. In the dynamic world of digital assets, macroeconomic factors and geopolitical decisions are increasingly exerting significant influence, particularly on the performance and investment flows into Bitcoin and Ether exchange-traded funds, ETFs. Recent analyses highlight how key economic indicators, such as inflation data released by the Federal Reserve, coupled with trade policies like tariffs imposed by major economies, are creating ripples across the crypto market, affecting investor sentiment and capital allocation. Understanding these external pressures is crucial for navigating the evolving investment landscape. The release of inflation data from the Federal Reserve often serves as a critical barometer for the health of the economy and the potential direction of monetary policy. When inflation figures deviate from expectations, they can trigger shifts in market sentiment, influencing interest rate decisions and, consequently, investor appetite for riskier assets like cryptocurrencies. For instance, higher than expected inflation might lead to expectations of tighter monetary policy, potentially dampening demand for assets perceived as speculative. Conversely, lower inflation could signal a more accommodative stance, which might boost investor confidence in cryptocurrencies. Simultaneously, the imposition of tariffs by governments, such as those historically implemented by the United States under the Trump administration, can have far-reaching economic consequences. Tariffs can disrupt global trade, increase the cost of goods, and potentially lead to retaliatory measures from other countries. These disruptions can create economic uncertainty, which often leads investors to seek safe haven assets or to reduce their exposure to volatile markets. In the context of digital assets, tariffs could indirectly impact crypto ETF flows by affecting overall market liquidity, investor risk tolerance, and the performance of companies involved in the digital asset space. The interplay between these factors is particularly evident in the flows into Bitcoin and Ether ETFs. These investment vehicles provide a regulated gateway for traditional investors to gain exposure to cryptocurrencies. When macroeconomic conditions are favorable and there is a general sense of economic stability, investors are more likely to allocate capital to these ETFs, driving up demand and potentially the price of the underlying assets. Conversely, periods of economic uncertainty, driven by inflation concerns or trade disputes, can lead to outflows from these ETFs as investors adopt a more cautious approach. Analysts are closely monitoring how these macroeconomic trends will continue to shape the digital asset market. The correlation between traditional economic indicators and the performance of crypto ETFs suggests that the integration of digital assets into mainstream finance is still heavily influenced by established financial frameworks. The success and sustained growth of crypto ETFs will likely depend on their ability to navigate these external economic forces and to offer investors a compelling alternative within diversified portfolios. As the market matures, understanding the impact of Fed policies and trade dynamics will be paramount for making informed investment decisions in the digital asset space. But what happens when the digital world collides with the harsh realities of crime and corruption? Stay tuned as we uncover a shocking corruption scandal that's shaking the foundations of justice. Gujarat Bitcoin extortion case, a stark warning for crypto governance and investor due diligence in India. The recent life sentences handed down to 14 individuals, including a former BJP MLA and senior police officers. In the 2018 Gujarat Bitcoin kidnapping and extortion case, serve as a critical wake-up call for the burgeoning cryptocurrency ecosystem in India and beyond. This complex criminal enterprise, which involved the abduction and coercion of a businessman for digital assets, has exposed alarming levels of corruption within law enforcement and political spheres, highlighting the urgent need for enhanced crypto governance and rigorous investor due diligence. The case revolved around Shailesh Bhatt, who had reportedly recovered 752 bitcoins from a failed BitConnect investment. This recovery made him a target for a criminal syndicate, allegedly led by Nalin Katadia, a former MLA, and a group of complicit police officers. Bhatt was kidnapped, subjected to severe physical and psychological abuse, and compelled to transfer 34 bitcoins, with further demands for a $3.6 million ransom. This harrowing ordeal illustrates the extreme risks that can arise when cryptocurrency holdings attract the attention of corrupt elements within society, blending sophisticated digital asset exploitation with brutal physical coercion. The judicial process, which involved examining 173 witnesses, culminated in guilty verdicts for 14 defendants on charges including criminal conspiracy, kidnapping for ransom, and illegal detention. The court's decision to issue notices under the Prevention of Corruption Act against implicated public officials underscores the systemic nature of the corruption involved. The imposition of life sentences highlights the judiciary's commitment to accountability and serves as a strong deterrent against similar crimes, particularly those involving public servants abusing their authority for illicit financial gain through cryptocurrency. This case has profound implications for crypto governance in India. It underscores the necessity for robust regulatory frameworks that can effectively monitor and control illicit activities involving digital assets. Furthermore, it emphasizes the critical role of due diligence for investors. Individuals engaging with cryptocurrencies must be aware of the potential risks, not only from market volatility and technological vulnerabilities, but also from criminal elements and corrupt practices. This includes thoroughly vetting platforms, understanding the legal landscape, and being cautious about attracting undue attention through large or unusual transactions. The successful prosecution and sentencing send a clear message that even in the rapidly evolving digital asset space, criminal activities will be met with severe legal consequences. It signals to both domestic and international investors the importance of understanding and adhering to local laws and regulations when dealing with cryptocurrencies. For India, this case is a pivotal moment, demanding a comprehensive review of anti-corruption measures and the strengthening of oversight mechanisms within its financial and law enforcement institutions to safeguard the integrity of the digital economy. And that's a wrap on our deep dives today. But before you go, let's quickly recap the headlines that made waves. Stay tuned for the lightning round recap. And that's a wrap for today's essential updates. We saw preferred stock offerings emerge as a novel way to gain Bitcoin exposure. Then, a major corruption scandal in India saw former officials sentenced for Bitcoin-related crimes. We also analyzed how Fed inflation data and tariffs are impacting crypto ETF flows and learned valuable lessons on investor due diligence from a Gujarat Bitcoin extortion case. Don't miss out on the next big story. Hit that subscribe button, ring the notification bell, smash that like button, and let us know your thoughts in the comments below. Follow us on all social platforms for more real-time updates. We'll see you next time.